Let me show you something that messes with people's heads. If you invested $10,000 into the S&P 500 using VOO back in 2016, today you'd have $40,000. That's solid. But the same $10,000 invested in VOOG using the same exact S&P 500 ETF, that would have grown to about $47,000. That's $7,000 that you would have left on the table. But look, this is where it gets spicy. There's actually a third S&P 500 fund that turned that $10,000 into over $52,000. Same companies, different strategy. Today, I'm breaking down 3 ways to own the S&P 500, while most people are stuck on level 1, and how you decide which level actually fits you. What's good, y'all? I'm Courtney. Welcome to Investing Uncomplicated, where we help the everyday investor make their money and the market make sense. Let's start with what everyone is doing. VOO is like the Toyota Camry of investing. It's reliable. It gets you where you need to go. It's never exciting, but it works. VOO owns all 500 companies in the S&P 500. It's weighted by market cap. That just means the biggest companies get the biggest slice of the fund. So think Apple, Microsoft, Amazon, Nvidia, all the heavy hitters. They carry most of the weight. The appeal is simple, okay? It's low fees, broad diversification, which means companies in different industries doing different things, and it's hands off. You put your money in, you ignore the noise, and you let capitalism do capitalism. Over the last decade, $10,000 into VOO turned into right around $40,000. Look, y'all, that's not wrong. But it may be incomplete because VOO treats every company style the same, even though not all companies grow the same. That's where the upgrades come in. So now let's level up. VOOG is the S&P 500, but with a growth filter. Same universe, same 500 companies, but instead of owning all of them, VOOG says, cool story, but I only want the ones that actually are growing fast. So what it does is it filters the entire index down to about 220 growth companies instead of the whole 500. We're talking Apple, Microsoft, Nvidia, Amazon, Tesla. These companies are reinvesting their profits, they are expanding markets, and most importantly, they're moving fast. VOOG is still passive. It still put your money in, sit back, let it do its thing. It's still diversified. It's still relatively cheap. And here's what that growth focus did. That same $10,000, it grew to about $47,000. That's roughly 19% more than the traditional VOO. And it didn't happen quietly either. In 2020, VOOG was up over 30%. In 2021, over 30% again. In 2024, it exploded with the AI boom. But, and this is important, growth investing, it has a personality, because in 2022, when rates spiked and tech got punched in the mouth, VOOG actually dropped almost 30%. Meanwhile, VOO, it dropped too, but not nearly as much. And that's the trade-off. Growth gives you higher highs and lower lows. Think of VOOG like a sports car. Fast, powerful, fun on the open road, but you feel every single pothole. Over 10 years though, VOOG still finished over $7,000 ahead of VOO. So the real question is not is VOOG better, it's can you handle the ride? Now, let me show you level 2. If investing feels confusing, it's not because you're behind, it's because no one ever explained it simply. Most people think investing is only for experts, rich people, or people who have everything figured out. And that's a myth. I host a free beginner investing class every Thursday and Sunday. In these classes, I break investing down in plain language. We dispel the myths, we build confidence, and I show you exactly what I look for in a stock. You don't need to be perfect to start investing. You just need clarity. And by the end of this class, most people realize they've been closer to investing than they thought. No pressure, no hype, no day trading, just the basics you actually need to start. If you've been waiting to invest because you didn't feel ready, this is for you. Register for the next free class using the link and take your first confident step into investing. You don't need permission to build wealth. You just need understanding. This is where most investors don't even know that they have options. Level 2 is SPMO. SPMO, it also starts with the S&P 500, but it doesn't care about growth labels. It asks one question: what's actually working right now? SPMO, it only owns the top 100 momentum stocks from the S&P 500. And twice a year, it rotates. Winners stay, losers get out. Think of it like VOO with a bouncer. If the stock ain't popping, you're not getting in. Here's what that did. $10,000 in SPMO turned into over $52,000 over the last decade. That's 32% more than VOO and about 11% more than VOOG. But here's the moment that sold me. VOO was down about 18%. VOOG was down almost 30%. But in 2022, SPMO, it was only down 10%. Y'all like, why is that? Because it rotated out of tech and into financials and energy automatically. No panic, no headlines. No, should I sell? Should I sell? Then in 2024, when AI came roaring back, it rotated right back into tech. You didn't have to time anything. That's the key difference. VOOG believes growth always wins eventually. SPMO believes momentum wins until it doesn't, and then it just adjusts. That adaptability is powerful, but it's not magic. Momentum can change fast, and SPMO will always be chasing what's hot. That's both the strength and the risk. Let's make this plain. Same 500 companies, different strategies. VOO is the foundation. It owns everything. Lowest stress, lowest volatility. It's perfect if you want to sleep well and not think too hard. VOOG, it's the growth bet. Higher upside, but lower downside. You're betting that innovation keeps winning long term, and you're willing to ride the waves. Now, SPMO, it's adaptive. It owns winners, it cuts losers, and rotates with the market. Highest returns historically, best protection in the ugly years. But here's the honest truth. VOO gives you average returns with average stress. VOOG gives you higher returns if you can emotionally survive the bad years. SPMO, it gives you the best math historically, but only if you trust the system and don't interfere. Guys, none of these are right. They're just different personalities. So you're like, well, what do we actually do with this? Well, option one is you pick your upgrade. If you're all VOO right now, that's fine. But ask yourself, can I handle big swings for big gains? That's VOOG. You ask yourself, do I want downside protection with the upside capture? That's SPMO. Do I want simple and boring and consistent? Then you stay with VOO. No shame. Now, there's another option. You don't have to go all in on any one of these. You can take a blend. So if you want VOO to be the foundation, you could take a larger percentage there. If you want to get a little bit of exposure to rapid growth, you can put a percentage in VOOG. If You really like SPMO and you feel like it does for your portfolio what you're really looking for, which is adding diversification with up and downside protection, you go SPMO. That combo gives you stability, growth, and adaptability. Historically, that blend would have turned $10,000 into about $44,000. Not the highest return, but the ride is smooth. There's a third option. You could take an age-based approach. This will work really well in a retirement account. If you're under 40, lean aggressive. If you're mid-career, balance it out. If you're closer to retirement, you want to lean heavier into VOO and lighter on the upgrades. The point is, you have choices. VOO is where everyone starts, and that's perfect. But once you understand that these are all just different ways to own the same 500 companies, you stop thinking in terms of best fund and start thinking in terms of strategy. VOOG bets on growth winning long term. SPMO bets on momentum winning short term. VOO bets on the average of everything. $7,000 to $12,000 over 10 years might not change your life by itself, but understanding how to optimize your S&P 500 exposure for the next 10 years, look y'all, that's real power. Look guys, I've dropped a link in the description where you can join my free beginners investing class, where I break down ETFs and the ways to invest your money for the everyday person, all right? Look guys, this isn't just about basic investing. This is about strategy. This is about understanding. This is about knowing how your money works the hardest for you. Here's the best part. Once you see it, you can't unsee it. Look guys, make sure you subscribe to the Investing Uncomplicated channel, turn on your notifications, and share this video with somebody you love. See you soon.